We want to start this topic called reconstruction. Now, when a company has been making losses for a long period of time, it becomes difficult for that company to pay dividends to their shareholders, and it also becomes difficult for that company to attract potential investors. Those are the two effects of a company which has been making losses over a long period of time. One, it is not possible for them now to pay dividends because they have been making losses, their shareholders. Number two, it is also impossible for them to attract potential investor. Of course, no investor would want to buy shares in a company where they are seeing retained losses in the books. Every year they keep seeing retained losses. No investor would want to buy shares in such a company. So the question is this: if you are such a company, then what is the most logical thing for you to do? What is the most logical thing for you to do? So let us assume you are a company A which has been making losses over a long period of time. Therefore, you're not able to pay dividends to your own shareholders or even to attract potential investors. What is the most logical thing for you to do? Now listen, the most logical thing for you to do as a company, therefore, is to reconstruct yourself. Now listen, the aim of reconstructing this company is to help this company to eliminate the accumulated losses. We don't want, as a company from now onward, to keep reflecting. Losses. What we do, we reconstruct our company with the aim of eliminating, that's the key word there, with the aim of eliminating the accumulated losses from the books of accounts. So in other words, we are saying the aim of reconstructing a company is to help this company to eliminate the accumulated losses and to start their activities from now onwards in a more attractive and profitable manner. We want to start our activities from now onward as a company in a more attractive and profitable manner. That's the aim of reconstructing a company. So from this year onwards, we don't want to reflect losses in our books. We want to eliminate those accumulated losses. And at the same time, it will help us to start our activities as a company in a more attractive and profitable manner. Good. That's the aim of reconstructing a company. So what we want to talk about now is how do you reconstruct a company? There are two ways or two approaches that a company can use in reconstructing itself. One way is through what we call internal reconstruction. A company can reconstruct itself through what we call internal reconstruction, or it can undertake what we call external reconstruction. So those are the two approaches that a company can use in reconstructing themselves. Either they use the internal reconstruction approach, or they use the internal reconstruction or the external reconstruction. Let me go back to the first one, and that is internal reconstruction. Now listen, when a company is reconstructed through internal reconstruction, all the stakeholders of the company, they are normally called into a meeting. These stakeholders may include ordinary shareholders, preference shareholders, debenture holders, creditors, and any other stakeholder of the company. So if we are reconstructing our company through internal reconstruction, we call a meeting of the stakeholders so that we ask them, what are they willing to sacrifice in order to help this company to eliminate the accumulated losses. What are they willing to sacrifice in order to help this company to eliminate the accumulated losses? For example, the ordinary shareholders might tell us, we owe them 20 million. They are willing to write off maybe 2 million from their capital. Preference shareholders, maybe we owe them 30 million. They may tell us they are willing to write off maybe 5 million from their capital, whichever it is. Debenture holders might tell us we owe them maybe 40 million. They are willing to write off maybe 2 million or whatever. Same to creditors. So we have a group of stakeholders, we have a meeting of stakeholders, and we ask ourselves, what can they do to help this company to eliminate the accumulated losses? Okay. I've said the ordinary shareholders might sacrifice part of their capital and reduce part of their capital. Preference shareholders also reduce part of their capital. The debenture holders also reduce part of their amount that we owe to them. Okay. Those are some of the items that they may come up with in their scheme of internal reconstruction. Now, from those few illustrations that I've already made, ordinary shareholders reducing their capital by 2 million, preference shareholders reducing their capital by 5 million, maybe debenture holders reducing their finances by maybe 2 million or whatever. So from there you can see that when it comes to internal reconstruction, in principle, from those three cases, you can already see that what this company is trying to do is to try and reduce the capital of the company. So when we say, listen, when we say internal reconstruction, the main thing when it comes to internal reconstruction is to reduce the capital of the company, Some books will call this approach, some books will call it capital reduction. Some books will normally call it capital reduction. So in other words, this group of stakeholders will have to sit down and come up with a scheme of what we can call a capital reduction scheme. They have to come up with a scheme of reducing their capital, so they come up with a capital reduction scheme. So in actual sense, that's all we can say in summary about internal reconstruction. That when it comes to internal reconstruction, the capital of the company is reduced. The capital of the company is reduced through a capital reduction scheme. We shall look at that in detail through what we call a capital reduction scheme. Now, when it comes to external reconstruction, let's assume, of course, we were assuming the company being reconstructed is company A. This company A may also be reconstructed through what we are calling external reconstruction. And when a company is reconstructed through external reconstruction, that company, they have to liquidate themselves, or in other words, this company should be liquidated, and they sell their business to another company. Let's call it company B. This company B may be another existing company. It may be another existing company, or it may be a newly formed company, There are some cases where a new company is formed so as to take over the business of company A. But we are saying when it comes to external reconstruction, this company that is being reorganized, it must first be liquidated. Then they have to sell their business to another company, which could be another existing company, or it could be a newly formed company, or it could be a newly formed company. Okay, so that's how external reconstruction takes place. So in simple, that's how we normally shall be referring to company A. They are selling their business. We normally shall be calling them the selling company. They are selling their business to company B. Company B, we shall be calling them the purchasing company. So in summary, therefore, that's what we are saying is what is involved in external reconstruction. That in an external reconstruction, a company is liquidated, which is that company A. It is liquidated and they sell their business to another existing company or a newly formed company. Good. So I want to go back now. I want to go back and discuss the details of the first approach, which is what we are calling the capital reduction scheme. The capital reduction, or what we can call internal reconstruction. Don't write yet. I'll put down the summary notes later. But let me discuss what we are calling internal reconstruction. Internal reconstruction. Okay? Let me discuss that first. The internal reconstruction. Okay? Now, we have already agreed that when it comes to internal reconstruction, a company calls the group meeting of stakeholders, and they agree and they ask themselves, what can those stakeholders do with an aim of helping this company to eliminate the accumulated losses? What can we as a company do to help our company? We as stakeholders, what can we do to help the company to eliminate the accumulated losses? Good. I told you that when it comes to internal reconstruction, the main thing is to reduce the capital of the company. The main thing is to reduce the capital of the company. Good. So let me now discuss each. Now, I said, suppose we have ordinary shareholders whom we owe them 20 million and they were willing to write off 2 million shillings. What entries do you make in our books as a company? What entries do you make into the books as our company? So let me start with number one now. Number one entry, we are saying, with amount written off on share capital, we agreed maybe as a group of stakeholders, ordinary shareholders will reduce their capital by 2 million. They will reduce their capital by 2 million. What should be the accounting entry? What should be the accounting entry? So let me illustrate first. Now listen. Let us assume our company has a share capital of 20 million. So in our ordinary share capital account, this company had a capital of 20 million, which is the balance brought down. 20 million. Now, I also want to assume that this 20 million comprises of maybe 2 million shares of 10 each. Our company had 2 million shares of shillings 10 each. That's how the capital comes to be shillings 20 million. Now listen. Then the question tells you these shareholders were willing to write off 1 shilling per share. They were willing to write off 1 shilling per share. The company has 2 million shares, and if the shareholders are willing to write off 1 shilling out of 10, they are writing off 1 shilling per share, then on their 2 million shares, it means they are writing off 2 million shillings. So with that 2 million, you will reduce the capital of the company by debiting share capital by that 2 million. You will debit share capital by that 2 million, and we shall be crediting an account we shall be calling capital reduction. We shall be crediting an account called capital reduction. So the double entry is you debit share capital and you credit capital reduction. And you credit capital reduction, and you come and see your ordinary share capital. The amount is 2 million. That's entry number one, which says with amount written off on share capital. With amount written off on share capital, you debit share capital and you credit this account we are calling capital reduction. And that's how we write off that amount. Now listen. There are some questions whereby the examiner does not tell you how much write-off per share. Like in this case, I've just said that we are writing off 2 shillings per share. This company had 2 million shares, and we are writing off 1 shilling. We are writing off 1 shilling per share. 1 times 2 million, that came to be 2 million. Now, listen. As a group of stakeholders, we could have met and agreed. Listen, we could have met and agreed. Let us cancel the old shares and replace them with new ones. Our company had ordinary share capital worth 20 million, but we agreed as a company that we are going to write off the old shares and issue new ones to replace them. Now listen, So if the question goes by that approach, you will go to the account called ordinary share capital. You will go to this account called ordinary share capital, which has a balance brought down, we have already said, 20 million shillings. Now the question tells you, we cancel the old shares. To cancel the old shares, you will debit you will debit share capital and credit capital reduction by the same 20 million. And you credit this account we are calling capital reduction by 20 million. And you come and say ordinary share capital, 20 million. Now listen. Then the question could tell you, the company issued, listen, the company issued another 2 million shares of shillings 9 each. The company issued another 2 million shares of shillings 9 each to replace the old ones. We have cancelled the old. Now we are replacing them by issuing 2 million shares of 9 each. Meaning that the company is issuing shares amounting to 18 million. Amounting to 18 million. That's 2 million shares times 9. That comes to 18 million. So we go on and say, now listen, we go on and say, with the nominal value of the new shares issued, with the nominal value of the new shares issued, which comes to 18 million, you will debit capital reduction and you will credit capital, you will debit capital reduction and you will credit ordinary share capital. With the nominal value of the new shares issued, which is about 18 million, you will debit share capital, capital reduction and you will credit share capital. And you come and say a capital reduction by 18 million. By 18 million. Now I want you to listen to this. The first approach was where the examiner told us to write off 2 shillings per share. The first approach is where the examiner told us to write off 2 shillings per share, 1 shilling, per share. Our company had 2 million shares of 10 each. They wrote off 1 shilling per share, which came to be 2 million. You can see I debited share capital here and I credited capital reduction with the amount written off, which was 2 million. Other questions here I've said, instead of giving you the amount write-off per share, they tell you cancel the old shares and replace them with the new ones. When I cancelled the old shares, I had to debit share capital here by 20 million. I had to credit capital reduction by 20 million. Then to replace the old shares, the question told you that we issued another 2 million shares of 9 shillings each. And that came to be 18 million. So with that double entry, I debited capital reduction by 18 million and I credited share capital by 18 million. Meaning in the share capital account, listen, meaning in the share capital account, we are still carrying forward, after that, we shall still carry forward an amount of how much? 18 million. We shall still carry forward an amount of 18 million, which is obviously the same amount like the first approach. The first approach, we wrote off 2 million shillings out of 20. When we wrote off 2 million out of 20, we carried forward an amount of 18 million. We carried forward an amount of 18 million. So either way, I hope you have noticed, listen, either way, I hope you have noticed that we are still reducing the capital of the company by an amount of 2 million. I hope you have noticed that either way, we are still reducing the capital of this company by 2 million. The first approach is where you wrote off 1 shilling per share times 2 million. That came to be 2 million. The second approach is where you are writing off 20 million first, then issuing another 18 million to replace the old ones. So you are still remaining with a capital of 18 out of the original 20. So either way, you are writing off an amount of 2 million. I hope you have noticed that. So it all depends with the question that the examiner will give it to you, whether he tells you to write off this per share, or he might tell you write off 2 million shillings. Like the first approach, he may give you the amount, write off 2 million. The second approach is where he does not give you the amount write off, but he tells you cancel the old shares and replace them with the new ones. Okay, good. So whichever way, I have explained how to deal with them when the examiner sets that. So I'm through with our entry number 1. I'm through with our entry number 1, which is what? With amount written off on share capital. We said effectively you debit share capital, you credit capital reduction. Good. Let me discuss number 2. What's the second entry? Number 2. Now, I told you in an internal reconstruction, the stakeholders are called into a meeting. And one group of stakeholders are the debenture holders and the creditors. Those are liabilities to the company. These are people we owe money to. And I told you we could be owing the debenture holders 40 million. Suppose they are willing to write off 3 million from their debt. What is the entry? That's what we want to discuss as number 2 now, which says with amount written off on liabilities, whichever liabilities. It could be creditors, it could be debentures, it could be bank loans, whatever liability the question tells you to write off. What should be the double entry? Double entry should be with amount written off on liabilities. We all know liability is always a credit balance. Liability is always a credit balance, whatever balance brought down. So whatever the question tells you to write off, you will obviously debit liability to write off, and you will credit the account we are calling capital reduction. So number 2 entry says with amount written off on liability, whichever it is, you debit capital reduction, you debit liability and you credit capital reduction. Whichever the amount you are told to write off, and whichever liability. Debit liability, you credit capital reduction. That's number 2. Now, number 3. Listen, I also told you when we are reconstructing a company through internal reconstruction, I told you a meeting of stakeholders will be called. These stakeholders could have said, to help this company to eliminate the accumulated losses, why can't we revalue some of our assets downwards? Why can't we revalue some of our assets downwards? Like machinery, we think it's overvalued, maybe motor vehicle, furniture, and so on. Why can't we revalue them downwards? That's what we want to talk about now under number 3, which says, number 3 says, with amount written off on assets, with amount written off on assets, whichever the asset, could be machinery, could be motor vehicle, could be furniture, and so on. Again, we all know assets are always a debit balance. Assets are always a debit balance. Therefore, to write off that asset, you will credit that asset, whichever the amount, and you will debit capital reduction. That's how to write off an amount on assets. Whichever the asset you're writing off, credit the asset and you debit capital reduction. That's our entry number 3. So the question will tell you which one are you revaluing. Maybe it's motor vehicle. You're told from the balance sheet, you can see it from the balance sheet of the company, it has a book value of 5 million. Maybe the question tells you it had a market value of 2 million. Of course, you are reducing the value of the motor vehicle or whichever it is. That's number 3. Let me go to number 4. What's our entry number 4? Now, I told you the aim of reconstructing this company is to do what? I told you when I was introducing the topic The aim of reconstructing this company is to help this company to eliminate the accumulated losses here. To eliminate the accumulated losses. We don't want to reflect losses in our books anymore from now onwards. That's the aim, to help this company to eliminate the accumulated losses. Now listen, meaning whatever losses the company has in their books, those losses must be eliminated. Those losses must be eliminated. Now, meaning therefore, if you go to the P&L account of the company, you will find a retained loss. You will find a retained loss. Losses, you obviously know from your accounting knowledge, you obviously know losses are always a debit balance. Losses are always a debit balance. So they must be written off. And therefore, to write off that loss, we shall be crediting the P&L account and we debit capital reduction. So we are saying with accumulated losses written off. With accumulated losses written off, you will debit P&L account and you debit this capital reduction. And you debit this capital reduction, whatever the amount. So losses, I've said, are always a debit balance and they have to be written off. Therefore, you credit the P&L account and you debit capital reduction. Now, so that's our entry number 4, which says with accumulated losses written off. With accumulated losses written off. Now, listen to this. Most of your past paper questions do not, listen, they don't remind you anywhere in the additional information to write off the losses. They will always talk about how much write off on share capital, which liability to reduce, which assets to reduce, and so on. But there is nowhere the examiner will normally remind you to write off the accumulated losses. Most of your past paper questions, your questions are silent. Listen. But whether the examiner reminds you, listen to this, whether the examiner reminds you or not, it is your responsibility to know why are we reconstructing this company. We are reconstructing this company with an aim of eliminating the accumulated losses. So when you are reconstructing a company, it is obvious the company must have been making losses. And it is obvious you cannot reconstruct the company and leave it with the accumulated losses. What I'm trying to say is, whether the examiner reminds you in the question or not about writing off the losses, you still must, after you have implemented all the additional information the examiner has given you in the question, before you close the accounts, you have to remember that this company has been making losses and those losses must be written off. Whether the examiner reminds you or it does not remind you, it is obvious that entry should be implemented. Which entry? The entry of writing off the accumulated losses. Yes, 1 or 2 questions have reminded you, but majority of your past paper questions don't remind you. Okay? Whether they remind you or not, still remember you have to write off the accumulated losses. Good. Before I go to number 5 now, let me mention 1 or 2 things. Before I go to number 5, let me mention 1 or 2 things before I go to our entry number 5. Then we put down the summary notes. But before we go to number 5, let me mention something here. Now, some of you are new to this class. Some of you are new to this class. So I want to tell you, or those who are with us for the normal class, please tell your friends that we are offering. Please tell your friends that we are offering online classes for advanced financial reporting. Tell your friends that we are offering online classes for advanced financial reporting. We are also offering online classes for financial reporting of the intermediate level. We also offer online classes, financial management, that is FM, of the intermediate level. And we are also offering financial accounting of the foundation level and the one of ATD1 and ATD2. In both levels of ATD1 and ATD2, there is accounting there. We also offer those ones. But we are saying, as far as CPA is concerned, we're also offering the foundation level FA. Those are the 4 subjects we are offering currently for online classes. Tell your friends we are offering online classes for those 4 subjects, either advanced financial reporting of the intermediate level, financial management of the foundation, financial management of the intermediate level, financial accounting of the foundation level, and the one of ATD1 and ATD2. Okay? Tell also your friends that if they are not able to join the live class, then they can buy what we call the pre-recorded videos, where they can watch the videos at their own free time, at their own pace. Where they can watch the videos at their own free time, at their own pace. If they can't join the live classes, they can buy the videos and watch them at their own free time, at their own pace. Good. Now, if you want to reach me, tell them if they want to reach me, they can reach me on this number 0722 65 8875. 0722 65 8875. Tell them they can reach me on that number 0722 65 8875. If you're using the country code, it's 254 722 65 8875. Call me on that number or text me on that number for more information. Good. Also, for some of you who are watching this through YouTube, for those who are watching through YouTube, please click the subscription button down there. Click that subscription button, subscribe to my YouTube channel. Click that subscription button, subscribe to my YouTube channel, so that you may be notified whenever we post new videos into the YouTube. Those which we are posting for free in the YouTube, you may be notified about them. If you are watching this through YouTube, please click that subscription button down there, subscribe. You can also like the video. I hope you have learned something so far. Even before we continue, you have learned something so far. If you have learned something and you feel you have liked the class so far, please click that like button. Click that like button, and you can also leave a comment. Click that like button. Good. So I think we can now continue. For those who want to know my YouTube channel, it's called CPA Joseph Njuguna. That's the name of the YouTube channel, CPA Joseph Njuguna. That's how you can reach my YouTube channel. I think that's all I wanted to say before we continue. We can now continue. That's all about the classes. Good. So allow me to continue and discuss the next entry now about internal reconstruction. So far we have discussed 4 entries. Let's now discuss number 5. Now, before I discuss number 5, let me mention this. Listen, you as an accountant, you have been called by company A to help them to reconstruct themselves. And they want you to help them to reconstruct themselves, maybe as from 31st of December, maybe 2024. They want you to help them reconstruct themselves as from 31st December 2024. So what you will do, you will tell this company A to give you all the information concerning this company. Or in other words, you try and collect as much information as you can from the company concerning this company. Maybe they will give you their income statement for the year. Maybe they will give you their balance sheet as at 31st of December 2024. and you will try and collect as much information as possible. Now listen, suppose in the process of trying to gather information concerning this company, you realize, now listen, you realize that this company, as at 31st December 2024, this company had a contingent liability. Suppose you realize that this company by 31st December 2024, it had a contingent liability. Now, this is not a new term to you. You must have heard contingent liabilities. You must have heard the term contingent liability. Now, listen. Let me not ask you to define for me a contingent liability. Maybe it will be easier for me to ask you to give me an example of a contingent liability. So maybe somebody can chat and tell me or give us an example of a contingent liability. Somebody to chat and tell us what is an example of a contingent liability that you know. There are too many. Instead of me asking you to define, good. Roy Teach has given us one. Good. Is there another one? Is there another one? We have been given one by somebody called Roy Teach. Yes. That's correct. That's correct. Any other? That's correct. Any other? Okay. Maybe I can use it. Maybe I can use it to illustrate what I want to illustrate so that we understand what's a contingent liability. Now, listen. As at the end of the year, one of your suppliers, you as a company, has taken you to court. And your lawyer has analyzed and said, listen, if the case is decided, of course you know it will be decided in the future. If the case will be decided and it goes against you as a company, maybe in that future, you will be required to pay damages of 2 million. And if the case goes in your favor, you may not be required to pay the 2 million. But as of 31st of December, the lawyer has analyzed and seen that the damages could be 2 million or we may not pay 2 million. Now, that's a liability to the company. Listen. But the question is, investigation spending. That's okay. Yeah, that's another example. Now listen. But as of 31st of December, if you go to the balance sheet of this company, will you find that 2 million as a liability? Remember, we are likely to pay that 2 million shillings if the case goes against the company in the future. Yes, potential penalties and warranties, another one, that's good. That's another example of contingent liabilities, the warranties, good. Now, listen. I was saying, we are likely to pay 2 million. We are likely to pay 2 million in the future. But then the point is, if you go to the balance sheet of this company as of 31st of December 2024, you will obviously not see a liability of 2 million in the books. You will not see a liability of 2 million in the books of accounts. No. But as a company, it is likely that we may be required to pay 2 million. So this is an example of a contingent liability. This is an example of a contingent liability. Now listen. What's a contingent liability? It's a liability which is likely to crystallize in the future. It is a liability which is likely to crystallize in the future, listen, depending on the occurrence or non-occurrence of a future event. It is a liability that is likely to crystallize in the future depending on the occurrence or non-occurrence of a future event. If the case goes against us, we shall pay the 2 million. If the case goes in our favor, we shall not pay 2 million. Now listen, but I've told you this liability of 2 million is not in the books. But as at 31st of December, we are likely to pay. So what do you do? Now listen, what do you do when you as a company, you have a contingent liability and you are reconstructing this company? It is now required that you as a company, now you should crystallize, listen, you should crystallize that liability immediately. Now that we are reconstructing the company, in case there is any contingent liability, that contingent liability should be crystallized immediately. Before we look at how to crystallize it, let me give you another example. Listen, our company has preference shareholders. And I want to assume we had a 10% preference share capital here. I want to assume that our company had a 10% preference share capital amounting to 30 million. Which means if our company has a preference share capital of 30 million and the preference shareholders normally earn a dividend at the rate of 10%, listen, at the rate of 10% every year, then it means that we as a company, every year, we are supposed to pay these shareholders. We are supposed to pay them their dividend amounting to how much every year? 3 million. 10% of 30 million is 3 million. Now listen. Remember, we have been making losses. So it's not possible for us to pay the dividend. We can't pay dividend. We have been making losses. But we owe the preference shareholders the dividend of 3 million. You know, preference shareholders are not like ordinary. Ordinary shareholders may lose their dividend, but preference shareholders are entitled to dividend every year. So if you don't pay them, it only accumulates. That's why we normally have what we call cumulative preference shares, which means you keep accumulating their dividend. Keep accumulating their dividend. So you may be told by the question that as a company we have not paid the preference shareholders for the last 3 years, meaning we owe them 9 million. This is something we are likely to pay in the future if we make profit. So listen, again, if you go to the balance sheet of this company as of 31st of December 2024, will you see a liability of 9 million by the name preference dividends in arrears? The answer is no. You will not see it. But do we owe them 9 million? Yes, we owe them 9 million. But if you go to the balance sheet, will you see the liability of 9 million? No. Now listen. Meaning therefore, now that we are reconstructing this company, we have to crystallize that liability. So another example of a contingent liability is what we can give as preference dividends in arrears. Any preference dividends in arrears that you as a company you owe your preference shareholders are an example of a contingent liability. Listen, and in your past papers, it is the most commonly used example for contingent liability. That you may be told, not all questions, some questions don't talk about it, some questions will tell you preference dividends are 2 years in arrears, 3 years in arrears, and so on. And if you go to the balance sheet of the company, you will not see dividends in arrears. But do we owe them? Yes. What the company just does is, they know, listen, companies just know, they know they have not paid dividend. but they don't show it in the balance sheet of the liability. They know they have not paid dividends for the last 2 years or 3 years. So they know, the company knows that they owe the preference shareholders maybe 9 million, but they normally don't show it in the balance sheet. Now that we are reconstructing the company, we have said, now that we are reconstructing the company, that contingent liability, whichever it is, it must be crystallized. I've given an example of preference dividends in arrears, So how do you crystallize it? That's what I want to talk about now. Listen, with any contingent liability arising, we shall be debiting capital reduction and crediting that contingent liability, whichever the liability. Could be preference dividends in arrears, it could be a pending court case, and so on. You debit, I've said now, debit capital reduction and you credit this contingent liability. Contingent liability. You come and see a capital reduction. Whatever the amount, okay? Whatever the amount. Listen, if you know the specific name of your contingent liability, then you open an account in the name of that contingent liability. Like in our case, we have given an example, preference dividends in arrears. So I would have debited capital reduction and I credit preference dividends in arrears here. I would have created an account called preference dividends in arrears. It's still a contingent liability account. Good. Now listen. Some questions go further and tell you that we have a contingent liability of preference dividends in arrears and so on. Listen. And the company decided, now that we are reconstructing a company, let's pay that liability immediately. So they decide to pay the liability immediately. Now that we are reconstructing, I've said that liability is not in the books, but now that we are reconstructing the company, we must crystallize that liability. In other words, make it a liability. How? By debiting capital reduction and you credit that contingent liability. Then I'm going further now on to say, if the liability is paid for immediately, then you will debit liability, which is contingent liability, and you credit bank or cash or whatever it is that you're using to pay. Okay? You debit contingent liability when you are paying and you credit bank or whichever liability, whatever amount or whatever item you're using. If you're giving them cash, credit cash. If you're giving them shares, credit shares. You could be told you're giving shares as a payment. You debit bank, contingent liability, credit shares. If you are giving them checks, debit contingent liability, credit bank. That's our entry number 5. Says, with any contingent liability arising, debit contingent liability and you credit bank. You debit capital reduction, debit capital reduction and you credit contingent liability. Then I've gone further and said, if it's paid for immediately, you debit capital contingent liability and you credit bank. Good. Number 6. Now listen to number 6. Now, after you have implemented the above transactions that we have discussed, normally this capital reduction account, normally it should be self-balancing. I've said, once you implement the transactions, this account we are calling capital reduction normally should be self-balancing. We normally use it just to help us to implement the scheme. Listen, but there are times when, after implementing the transactions that we have just been implementing, you still realize that the account is not balancing. There could be a balance in the account, and in most cases, you may find it on the debit side. That's what we want to discuss as number 6. What if there is any balance in the capital reduction account? So our entry number 6 says, with any balance in the capital reduction account, with any balance in the capital reduction account, that balance, listen, that balance should be considered as a capital reserve. It should be considered as a capital reserve. That means you will debit capital reduction. You will debit capital reduction and you credit an account we are calling capital reserve. Good. That's all we can say about the accounting entries for internal reconstruction, where we are to reconstruct the company through an internal reconstruction. Number 1, I've said, with amount written off on share capital, what do? With amount written off on share capital, we have said you debit share capital and you credit capital reduction. Number 2, we have said, with amount written off on asset, you credit asset and you debit capital reduction. Number 3, I've said, with amount written off on, that was number 3, sorry. Number 1, with amount written off on share capital, you debit share capital, you credit capital reduction. Number 2 was with amount written off on liability, With the amount written off on liability, we said you debit liability, you credit capital reduction. Number 3, I said with the amount written off on assets, you debit capital reduction, you credit asset. Number 4, I said with the accumulated losses written off, you debit capital reduction, you credit P&L. Then number 5, I've said with any contingent liability arising, debit capital reduction, you credit contingent liability. And I said if the liability is paid for immediately, you debit that contingent liability and you credit bank. Then finally, number 6, we are saying with any balance remaining in the capital reduction, being a reserve, you debit, being a capital reserve, you debit capital reduction and you credit capital reserve. Good. So let us put down the summary note of what we have already said so far before we proceed. I want to believe we are together so far. Somebody to chat and say yes. I want to know we are together so far. You chat and say yes. I want to know that we are together so far. Chat yes, I'll see it on my screen. I hope we are together so far. Yes, good. Thank you. Okay, good. So let's put down the summary notes now. Let's put down the summary notes. Then we develop the topic slightly now. So you write down this topic, reconstruction. The topic is reconstruction. 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 Then you say this. Reconstruction. Reconstruction. Then you say this. When a company has been making losses, over a long period of time, when a company has been making losses over a long period of time, when a company has been making losses over a long period of time, it becomes difficult, that company, it becomes difficult for that company to pay dividends. It becomes difficult for that company to pay dividends and even to attract potential investors. It becomes difficult for such a company to pay dividends and even to attract potential investors. And even to attract potential investors. Therefore, there may be a need to reconstruct such a company. Therefore, there may be a need to reconstruct such a company. There may be a need to reconstruct such a company. Stop. Continue. Another paragraph. The aim of reconstructing a company, the aim of reconstructing a company, the aim of reconstructing a company is to help the company. The aim of reconstructing a company is to help the company to eliminate. The aim of reconstructing a company is to help the company to eliminate the accumulated losses. To eliminate the accumulated losses from the books of accounts. Help the company to eliminate the accumulated losses from the books of accounts. Aim of reconstruction company is to help the company to eliminate the accumulated losses from the books of accounts. Continue. And to enable the company to start its activities, to enable the company to start its activities, and to enable the company to start its activities in a more attractive and profitable manner. 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 Another paragraph. Reconstruction may either be number one, reconstruction may either be, number one, internal reconstruction. Reconstruction may either be, number one, internal reconstruction, then you put a dash. Internal reconstruction, where you put a dash. We have said reconstruction may either be, number one, internal reconstruction, put a dash, where the capital of the company, is reduced. Where the capital of the company is reduced through, a capital reduction scheme. Where the capital of the company is reduced through a capital reduction scheme. Where the capital of the company is reduced through a capital reduction scheme. Number two, external reconstruction. Number two, external reconstruction. External reconstruction. External reconstruction. This occurs where another existing company or a newly formed company takes over the business of the company being reorganized. This occurs where another existing company or a newly formed company takes over the business of the company being reorganized. Good. Let's go back now into the details of internal reconstruction. To have another subheading, internal reconstruction. Internal reconstruction, put in bracket as a subheading, internal reconstruction, put in bracket, capital reduction. We say that is in essence the name of the topic. Internal reconstruction, in bracket, capital reduction. Let's put down those accounting entries, and the following are the accounting entries. The following are the accounting entries for internal reconstruction. The following are the accounting entries for internal reconstruction. The following are the accounting entries for internal reconstruction. Number one, with amount written off on share capital. Number one, with amount written off on share capital. With amount written off on share capital. Debit, share capital. Credit capital reduction. Debit share capital, credit capital reduction. Debit share capital, credit capital reduction. So we are debiting share capital. It could be ordinary, it could be preference, whatever you're told to write off. Just go to that share capital, you debit share capital, and you credit capital reduction. You're saying with amount written off on share capital, you debit share capital, you credit capital reduction. Then you can say NB, note this, where the old shares have to be cancelled. Where the old shares have to be cancelled and replaced with new ones. Where the old shares have to be cancelled and replaced with new ones. Number A under that. Number A under that. With the nominal value of the old shares cancelled. Number A, with the nominal value of the old shares cancelled. With the nominal value of the old shares cancelled. Debit share capital. Debit share capital. Credit capital reduction. Debit share capital, credit capital reduction. With the nominal value of the old shares cancelled. Debit share capital, you credit capital reduction. Debit share capital. Then you credit capital reduction. That's number A. Number B. Number B. Number B. B. With the nominal value of the new shares issued. With the nominal value of the new shares issued. With the nominal value of the new shares issued to replace the old ones. With the nominal value of the new shares issued to replace the old ones. With the nominal value of the new shares issued to replace the old ones. With the nominal value of the new shares issued to replace the old ones. Debit capital reduction. Debit capital reduction. Credit share capital. Debit capital reduction. Credit share capital. Debit capital reduction. Credit share capital. Okay. That's all for number one. Let's go to entry number two now. Number 2, if you are through with number 1, let's go to number 2 now. 2 says, with amount written off on liabilities, with amount written off on liabilities, with amount written off on liabilities, debit, liabilities, debit liabilities, credit capital reduction. Debit liabilities, credit capital reduction. Debit debit liabilities, credit capital reduction. Okay, that's our entry number 2. Let's go to number 3 now. Number 3. Number 3, with amount written off on assets. With amount written off on assets. With amount written off on assets. Debit, capital reduction. Debit capital reduction, credit assets. Debit capital reduction, credit assets. Debit capital reduction, credit assets. That's number 3. We now go to number 4. Number 4. With accumulated losses written off. With accumulated losses written off. With accumulated losses written off. Debit, capital reduction. Debit capital reduction. Credit P&L. Debit capital reduction. Credit profit and loss. That's number 4. Number 5. With any contingent liability arising, with any contingent liability arising, e.g., with any contingent liability arising, e.g., preference dividends in arrears, with any contingent liability arising, e.g., preference dividends, with any contingent liability arising, e.g., preference dividends in arrears, with any contingent liability arising, e.g., preference dividends in arrears. Debit, capital reduction. You debit capital reduction and you credit contingent liability. And you credit contingent liability. You debit capital reduction and you credit contingent liability. Then you can say this: NB, if the liability is paid for immediately, if the liability is paid for immediately, NB, if the liability is paid for immediately, debit, contingent liability, debit contingent liability, credit bank. If the liability is paid for immediately, debit contingent liability, credit bank. Number 6. Number 6. Number 6. With any balance remaining. Number 6. With any balance remaining in the capital reduction account. Any balance remaining in the capital reduction account. With any balance remaining. With any balance remaining in the capital reduction account. Any balance remaining in the capital reduction account. Being a capital reserve. Being a capital reserve. Being a capital reserve. Debit. Capital reduction. Debit capital reduction. Credit capital reserve. Debit capital reduction. Credit capital reserve. That's all for those 6 entries. So finish. I want to develop the topic slightly. Finish. I want to develop the topic slightly now. Finish. I want to develop the topic slightly. Okay. Now listen. Before I develop, I want to ask you a few questions. I want to ask you a few questions on what we have already said so far. Listen to my question. We started by saying the stakeholders are called into a meeting and they agree what they are willing to sacrifice in order to help this company to eliminate the accumulated losses. Listen. Number 1, I say, the ordinary shareholders may tell us they are willing to write off 2 million. What did we do? Look at now. I had to debit share capital by that 2 million. I had to credit capital reduction here by 2 million. My question is this to you. To the company, listen, to the company, is that a gain or loss? Repeating, we called a group of stakeholders. We asked them what they were willing to sacrifice in order to help us as a company to eliminate the accumulated losses. One group of stakeholders we called are the ordinary shareholders. We asked them, what are you willing to do for us in order to eliminate these accumulated losses? They say, you are willing to write off 2 million. So me as a company, I had to debit share capital, I had to credit capital reduction. So the question is, to us as a company, is that a gain or loss? Somebody to chat. Is that a gain or loss to the company? Is that a gain or loss to the company? Gain. Somebody else? Mary says gain. Another person says loss to the company. I don't know who is right. Toroitich is putting all the explanation. I wanted just a gain or loss to the company. It says a gain to the company and a loss to the shareholders. Okay. Now listen. I say to the company, not to the shareholders. We were asking ourselves, we are the company that we are reconstructing ourselves. We called the ordinary shareholders and they were willing to write off 2 million shillings from their capital. So as a company, we debited share capital and we credited capital reduction. That is obviously, listen, that is obviously a gain to the company. Why? Because we as a company, we are reducing what we owe to the ordinary shareholders. They are reducing their money. They are willing to write off. So as a company, we are gaining because they are writing off something from their capital, meaning we as a company, we are reducing what we owe them. So to us as a company, of course to them is a loss, but to us as a company, and that's what I was asking you, is it a gain or loss? Remember, we are the company doing the recording. So we are looking at it from the point of view of the company. So to us as a company, that's a gain. That was number one. Number two, I told you again, in town reconstruction, stakeholders are called into a meeting. Who else did we call? We called the debenture holders. And we can see we owed them 40 million here. They were willing to write off 3 million. So we say, with the amount written off on liabilities, we had to go to the liability account, which I opened somewhere here, and we had to debit this liability, and we had to credit capital reduction here. So again, the question is, to us as a company, is it a gain or loss? To us as a company, we called in the debenture holders or maybe the creditors, and we told them, what are you willing to do for us? They said they are willing to write off this much. So we as a company, we debited whichever liability and we credited capital reduction. Question is, to us as a company, is that a gain or loss? Put it down. I want to see the chart. Gain or loss? Gilbert says gain. One more chart, one more comment. One more comment. Many have said gains. That's true. Many have said gains. Now listen. Listen to this again. It's obvious that as a company, we are reducing what we owe to the debenture holders or to the creditors. That's a gain. A gain. Number three, we said, we as a group of stakeholders, we agreed, why can't we revalue some of our assets downwards? To reconstruct the company, let's revalue some of our assets downwards. Could be machinery, motor vehicle, furniture, building, whatever. And I told you, we know assets are always a debit balance. So to write off the assets, we said you credit the asset and you debit capital reduction. Question again. Question again. To us as a company, is it a gain or loss? With amount written off on assets, we sat down and agreed, let us reduce some of our assets, machinery or furniture, building, whichever. Whatever the amount we wrote off, we have to debit capital reduction and we credit the asset. The question is, to the company, is that a gain or loss? Okay, many of you have said losses. Many of you have said loss. That's correct. Listen to this now. That's true. Remember, we are the company reducing our own assets. So as a company, we are losing. So that's a loss. Let me jump to number 5. Let me jump to number 5, where I told you, listen, where I told you, with any contingent liability arising, we said you debit capital reduction and you credit contingent liability. I told you that when you are reconstructing a company and you realize that this company has a contingent liability, I told you that liability should be crystallized immediately. It should be crystallized immediately. Now listen, I told you contingent liabilities don't appear in the balance sheet. When you are crystallizing them immediately, you make them a liability. So we had to debit capital reduction here, and we had to credit contingent liability. Where was it? Here. Question to you is, when we debited capital reduction and credited contingent liability, is that a gain to the company or a loss to the company? With any contingent liability arising, we had to debit capital reduction and we had to credit contingent liability. So the question is, to us as a company, is that a gain or loss? Waiting to hear. Good. Most of you have said losses. Karen says loss, and others. Good. Mary says loss. Good. So most of you have said the correct amount or the correct thing, loss. Why? Listen, let me explain. Before we reconstructed this company, before we started reconstructing, this company did not have a liability in the books. They did not have a liability in the books. But now that we are reconstructing, we are required to make it a liability in the books. So it means, therefore, from now onwards, our company will have a liability, while before reconstruction, we did not have a liability. So our liabilities are like increasing. Okay? So that's a loss to the company. That's a loss to the company. Good. Now, I've asked you those 4 questions, and from those 4, listen, from those 4, I hope you can notice a pattern. I hope you can notice a pattern. That's what I'm hoping. That from those 4, you have noticed a pattern. Yes. Now, the pattern I hope you have noticed is this. It looks like every time the company was making a gain, that gain was being credited. Every time the company was making losses, that loss was being debited. Okay? That loss was being debited. Anytime we made a loss, we had to debit. Anytime we make a gain, we had to credit. Now listen to my concern. Why did I take you through all this? The reason is this. There are some past paper questions in your exams whereby they give you something like additional information number 5, number 6, number 7, and so on. Listen. But that additional information is not among these 6 entries we have mentioned. They give you a transaction to implement in the scheme, but it's not among the 6 that we have already discussed. But when you analyze that transaction as a student, you realize that this company will make a gain. By analyzing that transaction and you realize the company will make a gain, automatically that gain has to be credited in the capital reduction. You go to the next note, whichever the additional information, and you realize that this company, when I implement this transaction, the company will make a loss. That loss has to be debited in the capital reduction. Let me give you an example for each. Say, anytime we are making gains, that gain should be credited in the capital reduction. Listen, suppose the question tells you, from the additional information, suppose the question tells you, share premium to be written off. As an additional information, you are told share premium to be written off. You all know that share premium is a reserve, and these are reserve that belongs to ordinary shareholders. Share premium is a reserve, and it's one that belongs to ordinary shareholders. So if the question tells you share premium to be written off, then it is obvious as a company we are reducing what we owe to the ordinary shareholders. So you will go to that share premium account. It's obviously a credit balance. Share premium is always a credit balance. So to write it off, you will debit that share premium, whatever the amount, and you will credit capital reduction. You come and see a share premium. We are gaining as a company. We are reducing what we owe the shareholders. Good. Another example. Suppose you read note number 10, whatever the question gives you, and you are told, in the process of reconstructing this company, our company had to spend 2 million shillings as a reconstruction cost. As a reconstruction cost. We have not come across that transaction in any of the 6 entries. But we are told we are spending 2 million to reconstruct the company. So it's obvious, as a company we are suffering a loss. We are it's costing us to reconstruct this company. Therefore, I've said that loss should be debited in the capital reduction. So if you are told we spent 2 million shillings to reconstruct the company, you will debit capital reduction and credit bank with the reconstruction cost. Whatever it is, you will debit capital reduction and credit bank. It's a loss, and that loss should be debited in the capital reduction. Good. So let's go back now to the notes. I've explained the key items that some questions don't give you some additional information. No, some questions give you additional information which is not among the 6. So somewhere you can say something like NB, andika somewhere NB, NB, then you say this, NB, say this, any loss that is made in the process, any loss that is made in the process of reconstructing a company, any loss that is made in the process of reconstructing the company should be debited. Should be debited in the capital reduction account. Any loss made in the process of reconstructing the company should be debited in the capital reduction account. E.g., reconstruction cost incurred. E.g., reconstruction cost incurred. Good. Another paragraph. Another paragraph. Any gain made in the process of reconstructing the company, any gain made in the process of reconstructing the company, any gain made in the process of reconstructing the company should be credited. Any gain made in the process of reconstructing the company should be credited in the capital reduction account. Should be credited in the capital reduction account. Should be credited in the capital reduction account. E.g., share premium to be written off. E.g., share premium to be written off. E.g., share premium to be written off. Good. Fine. So we are through with this entry now. So what we want to do, which we can do next time, is now to do a past paper question. At least we have introduced the topic now. So we are in a position to do a past paper question. Okay? We can't do one for now. Maybe we can stop there for today. We'll pick it up from there next time. But I've told you, please, if you are watching this through YouTube, click the subscription button and subscribe. If you have not subscribed to my YouTube channel, please subscribe to my YouTube channel by clicking that subscription button down there. We have said the YouTube channel is called CPA Joseph. You're gonna click it. I've also said, click the like button. I want to believe you have managed to learn something today. Click that like button. Okay? Click that like button. And you can even leave a comment on whether you have understood what you have learned today. I hope you have learned something. Then I've also said, please tell your friends that we are offering online classes for 4 papers. Now, as at now, one is advanced financial reporting. We're also offering online classes for financial reporting of the intermediate level, financial management of the intermediate level, financial accounting of the foundation level. Then I said the one of ATD1 and ATD2. I also said if they can't join the live class, then they can buy the pre-recorded videos where they can watch the videos at their own free time. Whenever they have a question, they can call me. Then I said if you want to reach me for more information, you can call me on this number 0722 658875. Or if you're using the country code, we said 254 722 658875. Please subscribe, click the like button, maybe leave a comment. Then I said the name of the YouTube channel is CPA Joseph Juguna. There are even more videos there for publication. Okay? See you next time. So I don't know whether you have understood. For those who are watching me now, I hope you have understood something. Somebody can give me a comment before we close the class. Give me a comment. I hope you have understood. Give me a comment. I hope you have understood. Or maybe it's a question. If it's not a comment, you can put a question. I hope you have understood. Yes. Yes. Torotich says and has understood. Thank you. Fine. So maybe we can stop there for today. Let's stop there for today. We pick it up from there next time. Understood. Yes, Mary says he has understood. So see you next time. Yes, for the comments. Thank you. Most people have now answered. Understood. See you next time. And please recommend to your friends about our classes. See you next time, where we shall now do a past paper question, understanding what we have done, then we shall develop the topic. Bye for now.